The GE Aerospace stock, ticker symbol GE, is currently trading live at $307.25, reflecting a significant plus 1.51% gain in today's intraday session. Now, the common expectation is that this strength is simply a continuation of the post-spin-off euphoria, fueled by the narrative of a pure-play aerospace giant finally freed from the baggage of the old General Electric conglomerate structure. Investors see the recent strong moves as the inevitable outcome of focusing entirely on commercial and defense jet engines, a business with a deeply entrenched duopoly position. They look at the impressive run-up from the $159 low over the last 52 weeks and think this is just the market catching up to the clear value of the core jet engine business, especially with global air traffic recovering and defense budgets remaining robust. That's the surface-level assessment, and while it's not wrong, it misses the far more critical and less discussed engine driving today's spike and the forward momentum, the sheer quality and profitability of their aftermarket services, specifically the maintenance, repair, and overhaul, or MRO, segment, which is a significant factor in how firms like Fidelity and BlackRock are aggressively increasing their institutional holdings. The unexpected insight, the element that truly differentiates the current momentum, is that the current stock strength is less about new engine orders, which are certainly coming in, as evidenced by deals like the one with Korean Air for GenX, GE9X, and LEAP engines, and far more about the durable scarcity in the global aircraft fleet. Airlines, faced with massive backlogs from both Boeing and Airbus for new jets, are being forced to extend the service life of their existing aircraft, and this reality is a gold investment catalyst for GE Aerospace. Every older engine that stays in the air for an extra year translates directly into more high-margin spare parts sales and higher revenue shop visits for GE's services division. The recent third-quarter earnings report, which saw the company not just profit and revenue expectations, but also significantly lift its full-year guidance, an impressive and relatively rare occurrence in the current uncertain macroeconomic environment, was primarily a services story. Adjusted earnings per share soared 44% to $1.66, and critically, their commercial engines and services units operating profit jumped a massive 35%. What's more, the company revealed that over 70% of that CES revenue came from those resilient, recurring, investment-grade aftermarket services. This is a higher percentage and a more profitable mix than many analysts had truly modeled, and it fundamentally changes the risk profile of the stock, making it less cyclical and more stable, much like a premium Fidelity mutual funds product with a long-term growth tilt. The general belief, as I mentioned, is that GE Aerospace is a great cyclical stock benefiting from the travel boom. The market looks at the increasing volume of new LEAP engine deliveries. Production of the LEAP engine, a joint investment with Safran, was up 40% year over year, and correctly assumes future annuity-like service money streams. But the deeper reality is a powerful contrarian take. GE Aerospace is acting like an industrial stock with tech-like service margins because the airframe supply chain is still broken. The delays and production constraints at the plane manufacturers mean the MRO business is booming now, not just in 5 years. This effectively shortens the time to profit on their installed base of engines. The company's internal operating model, which they call Flight Deck, is actually performing much better than expected in tackling supply chain constraints, allowing them to increase material inputs from priority suppliers by a substantial amount. This operational improvement directly enabled the surge in engine output and services revenue, proving that their internal execution is exceeding the industry's external bottlenecks. If you are comparing this to an intelligent portfolio that is supposed to maximize efficiency, GE Aerospace is demonstrating an internal operational structure designed to extract maximum value from a constrained environment. Looking at the institutional activity, the movements from major Fidelity Investments competitors and other large institutions are telling. While the latest detailed filings are delayed, the clear buying pressure and upward momentum over the last few months, especially in the lead-up to and immediately following the latest guidance raise, suggest that big individual brokerage investment accounts have been accumulating shares. The stock's Relative Strength Index, or RSI, is in a healthy range, reflecting strong sustained accumulation rather than a momentary speculative spike that one might associate with platform like Robinhood. The megacap is now firmly in the megacap territory, validating its status as an aerospace powerhouse. This stock is not merely a cyclical play, it's a secular growth story anchored by an installed base of nearly 49,000 commercial engines and 29,000 military engines. The investment thesis here is about the long tail of services on that massive installed base, which generates predictable, high-margin money year after year, irrespective of short-term economic fluctuations, a very comforting thought for anyone setting up their own self-investing plan. The underlying business model of GE Aerospace is deceptively simple and incredibly lucrative, which is why the stock trades at a premium PE ratio relative to the broader industrial sector. It's an engine razor services blade model. The initial sale of a new jet engine often comes with lower margins, the razor, as manufacturers compete fiercely for market share on new platforms like the LEAP and the massive GE 9X. The real money, the blade, comes from the decades-long stream of aftermarket services, spare parts, scheduled maintenance, and performance upgrades. These contracts are generally long-term, sticky, and essentially non-competitive once the engine is chosen, leading to operating margins that can be significantly higher than the equipment sales. Their recent military business is also showing surprising strength. The defense segment saw a significant 75% profit growth year over year alongside a 26% revenue climb. This dual focus, commercial dominance through services, and a reliable military anchor provides a degree of stability that few industrial companies can match. For investors who use platforms like Interactive Brokers to track global industrial supply chains, this duality is a key defensive characteristic. In terms of future outlook, the expectation is simple: continued strength driven by airline recovery. The reality is more nuanced and interesting. The core catalyst for the next leg up won't just be a smooth increase in new jet production. It will be the successful investment and commercialization of next-generation engine technology. GE Aerospace is making substantial investments in its RISE program, which is focused on advanced technologies for the future of flight, including an open fan design intended to reduce fuel consumption by 20% compared to today's engines. Additionally, their partnership with Beta Technologies to co-develop hybrid electric propulsion systems is a calculated strategic move to position themselves for the smaller, regional air mobility investment realm and next-generation defense platforms. This commitment to future-proofing their technology, along with their ability to efficiently execute on current supply chain management, as demonstrated by the $30 million capacity expansion in their Pune facility, which uses their flight deck system to double output without increasing headcount, means they are simultaneously optimizing the present and planning for the long-term future. This is the hallmark of a resilient, high-quality industrial investment. The risks, of course, include the continued instability of the broader aerospace supply chain. A major unexpected failure at a key sub-tier supplier could slow their high-margin services revenue stream. Moreover, while a strong defense segment provides stability, a sudden shift in U.S. or global defense spending priorities could impact future military contracts. Geopolitical tensions, which directly affect global air travel confidence and defense spending, are an ever-present factor. But the current momentum is strong enough that the expectation is for GE Aerospace to navigate these headwinds better than most peers, primarily due to the high-quality, high-margin, and highly recurring nature of that services business. The spin-off of GE Vernova, which is the final step in the dismantling of the old General Electric conglomerate structure, now complete, has fully clarified the value proposition, removing the conglomerate discount that plagued the stock for decades. This is why you are seeing aggressive analyst price target raises and positive comments from major financial institutions. The story is clean and the execution is sharp. Comment below how you are approaching the aerospace and defense sector right now. Are you focused on services-heavy companies like GE Aerospace, or are you favoring airframe manufacturers despite their production struggles? The way forward for this stock is tied to its ability to leverage its proprietary technology and massive installed base into an annuity-like services investment vehicle, and the latest earnings report suggests they are doing exactly that, which is why the stock price continues to outperform the general market, exceeding the modest expectations of a simple cyclical recovery play. For anyone who uses a Schwab Intelligent Portfolios or a SoFi Invest platform, the core takeaway is clear. This is a case where operational excellence in a constrained environment is driving premium valuation. The company is successfully transforming its legacy industrial base into a modern, high-margin service powerhouse, validating the self-investing thesis that a focused business structure delivers superior shareholder value. Finance disclaimer. This video is for educational and informational purposes only and should not be considered financial advice. Always conduct